Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. See you again, dear brothers and sisters. Now we try to continue our previous discussions. The previous discussion has covered some topics, namely the nature of the risk and regulations, and also about risk management in the banking sectors. And right now we try to carry on the discussion on the evolution of risk management and regulation in banking. Yeah. So you see that the risk is going to be more complicated. Yeah. So every banking sector here cannot avoid, even cannot entirely mitigate the risk, because the risk almost happened in every sector of institution, particularly banking sectors. So in here we have three issues here that coming to be very important in the banking sector. The first is the capital, liquidity, and competitions, whereby these three items will be in place in the banking operations. As mentioned previously, that the capital actually is the buffer for mitigating any potential risk in the banking sector. And why capital needed? Because somehow the bank experience the mismatch in their balance sheet. Maybe you have known previously what is the mismatch. Mismatch actually is the imbalance between what they obtain and what they spend. For example, the bank here, they obtain the fund from the funding from the deposited fund, for example, 1 rupiah, and they should spend the money that they have already got from the deposited customers for around 5 rupiah. So here you see that the bank happens to be mismatched, 1 and 5. So logically, how the banking sector will finance this 5? In fact, they only have 1. Therefore, somehow the bank should take the capital, in order to improve the capacity of the banking activities. And liquidity become important, because if suddenly the borrowers can be able to collect or pay back their obligations, so the bank will face liquidity mismatch. The bank cannot entertain in case deposited fund is withdrawn by customers. Therefore, here the liquidity become important in order to stabilize the balance sheet of the banks. And the competition here refers to the condition whereby bank tries to maximize their values. Values means the capital, the profits, and the share values to the stakeholders. So if we try to integrate between capital, liquidity, and competitions, you will find the one terms, namely leverage. Leverage means the ability of the bank to promote the activities, even though their own fund is not liquid enough, is not enough to promote such extraordinary activities. And the next one, in here, competition in banking basically is due to the existing liberalizations of the financial markets. Therefore, these globalizations make banks have no borders. So the bank compete each other. They try to entertain and market their products to the entire population without limits. So it will promote the competitions. And the next one is that because of the bank tend to have ability to face illiquidity, and maybe risk in their operations, here the supervisors must be coming in. Yeah. The role of supervisors become very important in order to make a rule and regulation so that the activity of the bank is not beyond the capacity that may endanger the economy as a whole. Yeah. And in Indonesia, basically, we have here Financial Services Authority that focus to the supervising the bank and regulating the bank. So, in conclusions, is that the evolution of the risk in the banking sectors is because of the existing competitions, yeah, in the economy, yeah, so that the bank will face leverage in their balance sheet, and this balance sheet may endanger the activity if there is no any prudent supervisory activities coming from the authority. Thank you very much for your very kind attention. See you on the next presentation. Wassalamualaikum warahmatullahi wabarakatuh.